Welcome to the Funding Foundation series from Top Hat Business Group. If you've already purchased a business, or you're planning to, you may run into a common challenge. How do I fund the day-to-day operations or cover short-term needs? Today, we're looking at working capital loans, how they work, when to use them, and how to avoid common traps. A working capital loan gives you access to funds for short-term business needs, things like making payroll, buying inventory, launching a marketing campaign, or covering seasonal dips. These loans are often repaid in 6 to 24 months, and they're designed to bridge the gap between expenses and income, not to finance major purchases or acquisitions. However, these are useful after an SBA acquisition to provide a cushion, especially if cash flow is tight in the early months. There's no one-size-fits-all working capital loan, but here are 4 common types. A business line of credit where you draw funds as needed and only pay interest on what you use. A short-term loan with a fixed amount and repayment schedule. A merchant cash advance, which is repaid daily based on sales. And invoice factoring, where you sell your unpaid invoices for quick cash. Each option has pros and cons, and costs can vary widely. We recommend working with one of our lending specialists to determine which is the best type for your situation. Working capital loans are best used when your business needs fast access to funds and you have a clear plan to repay. Common use cases include covering expenses during a seasonal slowdown, buying discounted inventory in bulk, hiring ahead of a growth surge, or dealing with an emergency like equipment failure or late receivables. In one example, a client used a $75,000 line of credit to hire 2 sales reps ahead of their busy season and doubled their revenue that quarter. The approval requirements vary, but lenders typically want to see at least 6 to 12 months of operating history, consistent monthly revenue, often $10,000 or more, bank statements, though some may request tax returns, and a credit score of 600 or higher, though some go lower. One thing to note, these loans fund fast, sometimes the same day, but due to the shorter terms and quick turnaround, you'll pay more in interest than with SBA or conventional loans. Working capital loans are useful, but not cheap. Here's what to watch out for. Many require daily or weekly repayments, which can choke cash flow. Terms are short, often under 12 months. And the true cost of capital can be very high if you don't read the fine print. Here's a tip. Always ask for the total repayment amount, not just the interest rate. A loan might have a factor rate of 1.3, meaning $100,000 borrowed costs you $130,000. Let's recap. Working capital loans are great for short-term needs. They are flexible, meaning you can use them for inventory, hiring, marketing, and other expenses. They are fast, but they can be expensive and may require daily payments. Overall, working capital loans are a fast, flexible loan product, but they do require strong cash flow and discipline. If you're unsure which option fits your situation, we can help. Visit tophatbusinessgroup.com or reach out directly to explore customized funding solutions. And don't forget to subscribe for more smart funding strategies from the Funding Foundation series and Top Hat Business Group.